I'm Jessica Minton for IB Times TV, and today I'm joined again by Karl Snyder of Garden State Securities. Now, Karl, it's always great to have you on the program.
Well, thanks. Thanks for having me back again.
Absolutely. Now, looking over the past year, it has been pretty crazy in the stock market when you're looking at the Dow and the S&P hitting these highs, and then we do see that disconnect versus the economy. Can we take a quick look with the last year? We've had these tax cuts in January, that sequestration cuts in March, and then the government shut down in October. How did all of these end up impacting the stock market?
Well, obviously they did have an impact, but a very short-term impact. As I talked to you one time before, I said, I think investors have become, to a sense, not necessarily numb, but used to the dysfunctionality that we're unfortunately seeing in DC. So some of those events, I think, leading up to it, we did see a little bit of a sell-off a couple of times, but nothing huge, nothing major, and the market continues to march higher. And I believe a lot of that is tied into the Fed.
Right.
That's the key thing right there, is what the Fed is going to do. And if I can, since you asked, I'll go into just a little. Going back, and there's a lot of great chart work that I like to look at. And going back to, his name is Tom McClellan. A lot of people know his publications. He's an analyst, does a lot of chart work, and he did a great chart not too long ago with the asset purchase program, how the Fed was increasing their asset purchases, and then how that represented or coincided with what the market did. It doesn't take a genius to see, but when I looked at the chart, it was great to see that the market was actually even projecting out when the Fed would slow down. So it wasn't even a matter of them tapering, it's a matter of, are they going to increase are they going to continue at the momentum, the rate of change of the asset purchases? So going back to different peaks, as I had looked at, back in 2007, the Fed was always in there purchasing or selling securities. So the advanced decline line in the market back in 2007 when we topped actually peaked for stocks 3 months before the Fed started to reduce asset purchases. So since 2009, if you just put them hand in hand, you'll just see that as the Fed goes, the market goes. As the market starts to discount the fact that the Fed is going to perhaps slow down the rate of purchases, that's when you start to see peaks, not major peaks, but peaks in the market back in 2010, especially in 2011 when we saw that over the summer. Then Bernanke came out of Jackson Hole 2011, and the market's been on a tear ever since. And you could see how accelerated the asset program has been purchased. And that's really the key. That's the guide right now. Things are somewhat better in the economy, but not great. We had numbers today that looked good on the surface, but if you backtrack, there's some flies in the ointment, but you can always say that about things, but that's the key right now.
Do you think we're headed for a correction in 2014?
You know, that kills all asset managers trying to make these predictions. You know, I'm more of taking what the market will give me. I like to form an opinion, but then I don't like to force my bias on it. So do I think we'll see? I personally think that for the year, we should do good in 2014. A couple of statistics I just wanted to kind of throw out there for you is that 2014 is a midterm election. And then midterm election years usually show market bottoms. So we're in an up market, so is history going to be on the side that we make a top early part of the year and then bottom out? Perhaps, and I wouldn't be surprised to see that because we're right now seasonally in the best part of the year. We're going through November through the end of April. The old adage, go away in May, and it's true. And sometimes the markets continue to hold, but the best 6 months empirically stated are, November through the end of April. So somewhere in the first quarter or the second quarter, it leaves the door open for us to start to see some downside. Multiples are getting a little bit hefty, but at the same time, I'm not saying now I'm positioning short or would be shorting the market, which I want. That's a dangerous thing. But I think we may get more than just a 2-3%. We've gotten very small dips. There really hasn't been any corrections or major sell-offs this past year.
Now, should we expect a Santa Claus rally since we are in December now?
The term Santa Claus rally started from Gail Hirsch, who founded that. And a lot of people have tried to change what it is. The actual Santa Claus rally is the last 5 trading days of December and the first 2 trading days of January. And historically speaking, that has been good for about a 1.6% move in just that time frame. And historically that happens. We do get that Santa Claus rally. So I wouldn't be surprised if that happens. I would be surprised if we didn't see I don't know if it's going to be 6%, but I would be surprised. It's just a good time of the year. Everybody feels good, wants to buy. It's just that's where it came into effect. However, though, what's interesting is if we don't get the Santa Claus rally, not always, but very good has it been an indicator if Santa Claus doesn't come to Broad and Wall, the bears come to call, is the saying. It's an old saying by Stock Traders Almanac, but it could be the beginning of what could be a bear market, or if not a bear market, a point where sometime later in 2014 you can buy stocks not just a little bit cheaper, but much cheaper. So I'm not calling the top or anything. I want to see how it plays out. So I would be of the mindset, yes, I think we see a Santa Claus rally. If we don't, I'll be on the alert a little bit more.
Do you think we'll see the Fed taper in 2014?
I don't know how they can. I knew you were going to ask that, and everybody says, well, even if they just slow down, they've boxed themselves in. And it's really an analogy of, it's an addiction. Everybody knows you have to stop, but they can't stop. You know, you keep,
right.
The Fed is like, they can't even start going to rehab. They haven't even started tapering. A lot of people say they can stop. There's an exit strategy. They can allow the paper that they're buying to mature and roll off their balance sheets. But the fact is, are they going to slow down the amount of purchases? They can, and at some point, obviously they will. Am I going to predict they will or won't? I'm going to take my cues from the market. I believe the Fed is more market dependent than data dependent. They say they're data dependent, but if you remember back in the end of August going into September's meeting when everybody thought they were going to taper, we saw a spike in interest rates, markets are starting to sell off, and what happened? No taper. Now, is that coincidence? I don't know. I just believe that the Fed has boxed themselves in where they're trying to reinflate or inflate the economy. They can't do it directly into the economy. So the only way is to keep cheap money, which allows asset classes to rise, like real estate, like markets.
And finally, besides the stock market, it is December, so this is really big for college football. What did you think of Alabama and Auburn last weekend?
Well, I'm glad we're going to finish on that.
Right.
That was fantastic. Auburn. I'm looking forward to hopefully beating Missouri this weekend, and then
right.
I want them to build a case to go to the national championship.
Right.
But I'm glad to see that.
Right. Well, I went to A&M, as you know, so
yes.
Huge Johnny football fan. So definitely brought a smile to my face.
Fantastic.
Seeing Alabama beaten like that. But it's always great. Thank you again for joining us.
And thank you.